Boy, that time flies when you're making progress, doesn't it? Welcome back, guys and gals. JJ here once again, schooltrade.com. Hope you're having a great week here so far. Back for another trading psychology question of the day. Great question. He says, I can't seem to stop over trading. He says, I don't know whether it's my emotions or maybe my personality isn't meant for trading. Maybe I shouldn't be a scalper. Maybe I should be a swing trader, right? Maybe it's the market I'm trading. He says, whatever the problem is, I can't seem to stay patient because at the end of the day, the only person making money isn't this truth. He says, the only person making the money is my broker, right? Is there any easy way to stop over trading? Boy, great question. Always appreciate you guys sending me your questions, and I'm sure a lot of people watching this video have dealt with the problem of over trading before. And in today's psychology lesson, I'm going to give you a strategy with 4 tricks that'll make it easier for you to kick the habit of over trading. But before I jump into today's lesson, I want to remind you, right, make sure you subscribe to our YouTube channel and make sure you adjust those settings so you always get notified every time I post a new video. And if you really want to stay in tune with what's going on here at School of Trade, head over to schooloftrade.com or sidewaysmarkets.com and join the mailing list. There'll be a link in the description of the YouTube video. All right, let's dig into it, right? The question of the day was, how do I stop over trading? This is a relatively easy question to answer, believe it or not. In the world of trading psychology, it always seems to be kind of complicated, but if you are over trading, that means, to me at least, you don't know your niche. You don't know your sweet spot. You don't know your best setups well enough, right? Because if you did, you would be able to stay patient to wait for them. Remember, trading, just like most small businesses, really only requires us to master a few certain setups. You know, the reason why most successful traders are successful is because they find a specific niche and they just maximize it right to their full potential. In other words, successful traders don't try to learn everything. They're not a jack of all trades. Boy, doesn't that fit well for us here as day traders, right? They master a few specific markets and a few specific setups. The easiest way to avoid over trading is to clearly understand your niche or understand your sweet spot, right? Whatever that may be. Now, I did a video a few weeks ago, and it was titled, Do You Expect to Win? And in that video, I talked about preparing for a few specific situations each day. In other words, telling you how to define your niche, right, and mastering those setups to avoid the problem of over trading. So if you want to stop over trading, the best solution is to clearly define what your niche in this trading world is going to be. So how do we define our niche? Well, when I say define your niche, let's think of 4 things that would help you define that niche, right? And the 4 things you want to think about to kind of define that niche would be the specific market or maybe asset class, right, like energies or metals or stock indexes. 2 would be a specific trading strategy, right? Trend follower, counter trend trader, contrarian, you know, whatever type of strategy you're going to use. Number 3 would be the chart time frame. You know, if you're on a 1-minute chart, you have to make decisions every 1 minute, and trades might last maybe 10 minutes. If you're on a 60-minute chart, right, you only make decisions every 60 minutes, maybe not, right? And trades can last a few days. So the chart time frame is an important aspect of deciding your niche. And then, of course, number 4, the final thing would be your decision-making rules, right? And that would be, are you going to use just black and white, no interpretation needed, right? Like I kind of recommend for new traders. Or are you more of an intuitive type trader, right? Are your decisions based on kind of guidelines, right? Generalities, right? So we're going to talk about these 4 categories: specific market or asset class, trading strategy, chart time frame, and decision-making rules. So let's take some time to think about these 4 aspects of defining your niche. First, let's talk about defining the specific asset class or market that you're going to focus on. Now, every market has a distinct personality to it, very much like a human being, right? We all have distinct personalities, just like every market does. Volatility, market structure, liquidity. You know, furthermore, some markets open up at midnight while other markets don't really move until, you know, early morning in the US. You know, different times they open. To be a successful trader, you want to find a market that fits your time zone, fits your kind of personality, right, of your individual personality. It fits well with volatility, liquidity, right? In other words, a good match of the type of markets you're going to trade, A good match will produce good results, right? Easy to trade. And a bad match will produce bad results, and it will manifest, right, in bad decisions, bad trading experience, and probably lost money. For example, I've learned over the years that the energy markets, things of crude oil and natural gas, right, have a distinct personality that really work well for me. For some reason, I just can read a crude oil chart better than I can read like a bond chart, right? They also open up at 9 o'clock Eastern time, which is also a good fit for me. I live here in Los Angeles on the west coast of the U.S., so it's difficult for me to trade certain markets that open up much earlier in the day, right? So, for example, the FDAX in Europe. I started my trading career dabbling with the FDAX. This is many, many, many years ago. But the problem I had was it traded overnight for me here in Los Angeles. It wasn't a good fit, right? So when I moved to crude oil, it was like, oh my goodness, this is so much easier now. I can actually live a normal schedule, right? The market opened up at a good time for me and just so happened to fit well with my personality and just the way the market moves. Now remember, there's no right or wrong answer to this question. Some people just read certain markets better than others, right? Some people live in certain parts of the world where it's just not easy to trade certain markets. You got to figure out which markets, right, work best for you. Now, once we know the specific market that we're going to focus on, now let's move to the strategy itself. Every trader needs a strategy, which will help them find reliable trading opportunities based on statistical analysis, right? Rotation between support and resistance, supply and demand, et cetera, right? Now, there are literally thousands of different types of strategies that you could use. Some traders like to follow the long-term trend, while other traders focus on short-term market psychology, like I do. Some traders like to pick tops and bottoms. They're more of a reversal, more of like a contrarian types of traders, right? That type of trading style makes my stomach hurt just thinking about it. While other traders watch divergence between related markets, or they trade a spread, or they're rapid fire, high frequency type of traders. Some people just can't trade on a longer time frame because they talk themselves out of positions, right? They can't sit still, whereas other traders struggle with the fast-paced movement of short-term trading. Again, I'm going to sound like a broken record on this. There's no right or wrong answer to this. But if you're going to be successful, you need to pick a trading strategy that fits your personality. As I mentioned earlier, I just don't feel comfortable trying to call reversals. It might be right in your wheelhouse, right? Sometimes I tell traders I only follow the trend, and they say, oh, I can't stomach buying pullbacks. I like to look for double tops and double bottoms and call reversals. There's no right or wrong answer, right? You're going to figure out which type of trading strategy sits well for you pretty quickly. If you're trying to call a top and a bottom in a trending market and you can't stomach the idea of trading into a bull market, right, fading a bull market, you'll know right away you're not meant for that type of strategy, right? It seems to be better for most types of traders. Okay, so now we have our market we're going to focus on. Okay, we're going to define the type of strategy that we want to trade, right? Now let's nail down the charts that we're going to use. Chart time frames, I think, are one of the most important aspects of defining your niche, right? And by defining your niche, you can avoid over trading. I know a lot of traders who like the idea of being a scalper, but when it comes down to actually scalping, right, which means real fast-paced, short-term trading, when it comes down to following the rules in a more rapid-fire environment, they don't do very well. Now, you put those same traders who struggle with rapid-fire trading, you put them on more of a swing trade basis, right? Slow the chart time frame down, and it just seems to fit better. I've also worked with traders who want to be swing traders, but they can't stomach the idea of going to bed at night with an open position. If you can't sleep at night because you have an open position, you probably either have to find another strategy, right, or get used to some late nights, right? So, in other words, do you find it easy to hold positions for a few days? Does that keep you up at night? Do you struggle to make quick decisions. These are things that are going to affect the type of time frame that you want to use, right? If you find it hard to keep up with a fast-paced market like crude oil, if so, maybe slow the time frame down, right? Or if by slowing it down, you can't sit there all day long and just watch and do nothing, then we have to dial it back up, right? And kind of find that good balance. Again, everyone's different. And you need to invest some time in practicing with different time frames, which will ultimately determine the time period of your trading strategy, and you can see what works best for you. Once you combine the correct market with the correct strategy, with the best fitting time frame, you'll find trading to become a whole lot easier. But now, let's talk about something that I don't think a lot of traders really appreciate, and that is, let's talk about in defining your niche, defining your actual rules. Now, some traders use rules, very specific, black and white rules for entries and exits, right? There's no room for interpretation. It's either yes or it's no, while other traders rely on their intuition. Some traders use rules as guidelines, while other traders keep them very, very strict. You probably met a few traders like this. I know off the top of my head, I have at least a dozen clients of mine that have taken my strategy and, they follow the rules, but they just have this way of kind of just feeling how things are going to work. For me personally, I don't have that luxury. I need things to be black and white, just kind of the way my personality is, right? Again, no right or wrong answer, right? Some traders do hours of research before they take a trade, and they set the trade on autopilot from there, while other traders allow the most recent price action to determine their next move. The market that you trade, the time frame you use, and the way you make decisions all need to match your personality, your style of thinking, and most importantly, really align with your personal strengths. When done correctly, trading becomes easy and fluid for someone who's properly matched with their trading style. But when we try to trade a strategy or trade a time frame or trade a market that doesn't fit our strengths or requires us to work outside of our sweet spot, we usually see quite disappointing results. And really the big thing is it's usually really difficult work. Trading becomes a lot of really hard work when you're trading against, right, your own personality fit. A good example of this would be in the sport of baseball. I know I use this analogy quite a bit on these videos, but, kind of roll with me on this, for example. When I was in high school, I played baseball. I wasn't a very good hitter, but I was a really good catcher. And when I was waiting to get to bat, my coach would always kind of get in my ear and say, hey, Joe, remember to wait for your pitch, right? Wait for your pitch. In other words, he was telling me to be patient and only swing at pitches that were best for me. Now, he would also keep stats for us, right? A good coach would keep records of what their players were doing. And I knew from experience in reading those stats that I had a much higher success rate when I swing at fastballs rather than when I try to swing at a curveball, for example, right? So my job as the batter, right, my job as the hitter in baseball was then to make sure that I only swing at pitches that were fastball, right? Swing at pitches that were suited to my strengths. The same is true for your trading career, my trading career, right? Same is true. When I trade a market that is well matched for my strengths, I do well. But when I try to apply the same strategy to other markets which aren't well suited or other strategies that don't fit my personality, I'll usually lose money, right? And it'll be really uncomfortable while I'm trying to trade. You'll feel it, right? It'll feel like you're kind of outside of your comfort zone. So just like a baseball player, a wise trader will know exactly what their strengths are and wait for opportunities to capitalize on them. It's much easier to avoid over trading when you know your niche. You know what you're best suited for. And that definitely takes a little bit of time to understand, especially since there are so many markets and so many different ways in which you can trade. I mean, when you think about it, right, I mean, there are hundreds of markets, hundreds of different chart time frames. On top of that, there are probably thousands of different strategies. I mean, no wonder it can take a while if you're trying to learn on your own. It can take a while to figure out, how do I use all of these tools? It's like it's like trying to bake a birthday cake with all the ingredients, but you don't quite know the recipe. You don't know how to use the ingredients, right? That's kind of what it feels like. All right. Now, in previous lessons, we discussed how important a positive attitude and optimistic mindset are for a successful trading career. And it's easy to see why that'll be much easier if you can successfully match your trading strategy to your trading strengths. If you do it correctly, trading will be relatively easy, and you'll see positive development, positive improvement, and success in the long term of your career. But if you don't, your trading will create stress, and that stress will lead to distress, and that distress will manifest itself into poor decisions and ultimately poor results. We've talked about that on previous lessons as well. So your job as a trader is to know yourself, know your strengths, know your weaknesses, and focus on operating in an environment where your strengths are being used far more than those weaknesses. You have to know when you're operating inside your niche and when you're operating outside your niche. A common problem with new traders is that they don't know their strengths yet, or they haven't found a strategy that plays to their strengths. That's like trying to hit a baseball with your eyes closed. Yeah, you'll get lucky once in a while. You close your eyes. I'll get lucky if I swing enough times, right? But overall, my batting average won't be high enough for me to be successful. Another problem among rookie traders, and I know I had this when I was a new trader, is I would allow performance anxiety, which we talked about earlier on this week, to interfere with the decision-making skills, right? I would take wrong trades outside of my niche, and I would lose money. Then, a few minutes later, a good trade appears on my chart, right? And I avoid that trade because I'm scared of losing money. You can see how this cycle works, right? You take the wrong trades outside of your niche, and that makes it harder to now take the right trades, right? Because you're worried about losses, right? That's one of the biggest challenges. So knowing your niche will help you avoid that problem of over trading. Now, what's your niche going to be? Right? What markets do you trade the best? What time frames fit your personality? If you could only trade one setup with one market and one time frame, what would it be, guys? Have you ever gone back and looked at all your previous trades to see what's working and what's not? Are you even keeping records of your trades? Right? Are you keeping a journal? Do you know the answers to these questions? I'll be honest with you, I certainly didn't know the answers when I started my career, but for some reason that didn't stop me from loading up my first 3 accounts, donating my hard-earned capital to all the more experienced traders in the market who knew their niches, right, and taking foolish losses that could have easily been avoided if I would have just taken a little bit more time at the beginning of my career, work with a mentor, or just simply invested the time on my own to actually learn, right, what my niche was. Remember, when we start trading, we become small business owners, right? When you become a trader, you are the owner-operator of your own small business. And what's the single most important factor of a successful business? You need to know one thing and do one thing really well. And only then can you think about expanding into additional products, and services, right? Take Amazon, for example, right? How did Amazon get started? They started by selling books. That's it, right? They weren't selling toothpaste and clothing, right? They did one thing really, really well, and that allowed them to then add on other additional products they wanted to sell as well. What are you doing really well in your trading career? Once you figure that out, you keep doing it. Just keep pressing that button, maximize that every day, right? Because eventually you'll realize that you don't need that many home run setups. You don't need that many go-to patterns, right, to make a really good income as a trader, right? So a wise trader, right, just like a wise business owner, is always watching their performance numbers, properly allocating their cash, and staying inside of their niche, right? That's one of the key components, right, to being a successful trader or a successful business owner. Boy, look at that time. 19 minutes already into this video. They don't call me Professor JJ for nothing. Let's grab some homework here. Here's some homework to help you stop over trading. First, your homework is to take a moment to clearly define your niche. What market, what time frame, what strategy, how are you using rules, right? Let's start from there. So get that right on paper. That becomes your niche you're using right now. Got to start somewhere. Then start using your trading journal, which unless this is the first video of mine that you've watched, if you've watched the entire psychology series so far, then you probably have already heard me talk about this journal dozens of times already, okay? I'll let you off the hook though if this is the first time you've watched these videos, right? But we talk quite a bit about a trading journal. Use that trading journal, or go back to the beginning of my psychology video series, use that journal and document each trade that you take. And I would recommend use a simple marking system that will help you identify all of your niche trades. So here's how it works. Use your journal, and each time you take a trade, I want you to label each trade as a number 1, a number 2, or a number 3 type of trade. Now, the number 1 trades, these are your best trades. These are your sweet spot. These are your niche trades. These are trades that when you see them and you take them, you most oftentimes make money. The number 2 trades are good trades, but they are using a slightly less reliable pattern, or they don't have the risk-reward ratio that you really need to have that number 1 trade. Now, number 3 trades are those trades that feel good in the moment. You know, maybe using some intuition to take those trades, but they actually fall just outside or maybe way outside of your niche. Okay, these number 3 trades are considered speculative or highly discretionary. They aren't part of your trading plan, and they often result in trading losses. Now, review these notes, review your journal at the end of each day and at the end of each week. Focus on the winning percentages of the number 1, number 2, and number 3 trades. So you can actually see for yourself that it's in your best interest to take only number 1 or number 2 trades, right? So you'll find out real fast what the winning percentages are of those 1, 2, and 3 trades. Another way to use this kind of scoring system is to total your numbers at the end of the week, right? And obviously the lower the number, the better you did at staying inside of your niche. For example, if you took 15 trades this week, right, your score could be 15. You took all number 1 trades all week, did a great job. But if you took 15 trades this week and your score is 45, right, you probably lost your shirt that week, right? And you now know you need to really do a better job next week at staying inside of your trading niche. The goal of this exercise is to capture the data from each trade and use that data to make educated decisions. Oftentimes, we don't even see the numbers, right? We don't see the writing on the wall until we read our journal and we go, wow, I didn't know that. I'm taking 75% of my winners are number 1 and 2 trades. All I have to do is remove number 3 trades, and I can now remove 25% of my losses. When you see the black and white data in your journal, right, it becomes really easy for us to then take the next step and be disciplined, right, to follow those rules, all right? So you'll see the numbers in your week. It'll make it a lot easier for you. Another reason this technique is so valuable is that if you go on a losing streak, and this is where I've really benefited from this kind of scoring system. If you ever find yourself on a losing streak, if you ever find yourself in a kind of a rut, you can scale back, right, drop your position size, and then build momentum back up, focusing only on those number 1 trades. You know, in my experience, losing streaks happen to me when I get overconfident, right? When I start taking trades outside of my niche because I've had so many consecutive winning trades. And if I have my journal and all the data collected correctly, well, then I can quickly adjust and get back on track mentally first, right? I can see the data, I can make the decision, and I can get back on track. Boy, oh boy, I've taken up way too much of your time here already. We've covered a lot on this video. Let's do a quick recap. The easiest way to avoid over trading is to clearly understand your niche or your sweet spot, whatever that may be. We talked about 4 ways to define your niche, right? Specific market class or specific market or asset class, specific trading strategy, the time frame you're going to use, and the type of rules or how you're going to use those rules. We spoke about the baseball analogy, right? To wait for your pitch. And to do that, you need to take good notes in your journal so you know what your pitch really is. We talked about keeping score of each trade that you take, labeling them as a 1, 2, or number 3 trade. By keeping that score, you can see the winning percentages of each type of trade, and you can also total them up at the end of the week and see how well you're sticking to your rules. We also talked about how keeping those notes of 1, 2, and 3 will allow you to break out of a losing streak to get you back on track, back into your trading niche. Boy, oh boy, let's wrap things up. I've taken way too much of your time. Hope you guys found a value in today's psychology lesson. I would love to hear from you guys and gals about additional topics that you might be struggling with as traders. So do me a favor, drop me a comment below the video or on my blog here at schooloftrade.com, right? And let me know what other topics you want to see me cover in my next psychology video. If you found value today, help me out by giving me a thumbs up on YouTube. Subscribe to our YouTube channel if you're not already, of course. And please don't forget to share this information with a trading friend. Because remember, guys, it doesn't matter what markets we trade or the strategies we use. Even the most experienced and successful traders battle with their emotions when there's money on the line. And don't forget, you can find me every morning at 8 o'clock Eastern Time, working hard in my trade room with all of our members here at School of Trade. I get a great free trial at the homepage of schooloftrade.com. Catch my nightly newsletter every evening on my blog at Sideways Markets. And don't forget to stick around. I'll be back in a few days on my next psychology lesson. As always, hope this helped by avoiding that classic case of overtrading. And don't forget, my name is Joseph. It's been great to have with you guys. We'll see you guys next time. Be well out there. Be nice to each other, will ya? Bye-bye for now.